you so much for joining in today's video. I would like to provide you with an alternative calculation to understand the performance of a company. We have looked at NPV for investment and capital allocation decisions. We have looked at IRR, internal rate of return. And now we are looking at a third figure, so-called return on invested capital. Sometimes you also call it ROCE, return on capital employed. It's basically the same. And how you calculate return on capital employed or return on invested capital is you take your after-tax operating profit, for example, your EBIT times 1 minus effective tax rate, so the operating profit that the company generates after tax. It's kind of cash flow equivalent, but it's not used, these are not cash terms, these are accounting terms, so you can actually get those information from financial statements. You don't need to do big calculations to do forecasting to create new free cash flow to the firm. And then what you do, you divide this number or this figure after tax operating profit by average invested capital. Average invested capital, again, this is a balance sheet number, that's why we call it average. And you take the previous year and this year and then take the average divided by 2 if it's a simple average, or you need to do some adjustments. And again here, what is after tax operating profit? It's your operating profit, EBIT, for example, 1 minus tax rate. If we look at what is invested capital first includes both equity invested capital and debt invested capital. So here you look at both capital providers, debt providers and equity providers. However, you exclude short-term liabilities because, as you know, and I think I've done another video, cash, short-term assets and short-term liabilities, this is working capital. And this is needed to run the company. So it's actually not really available to look at or to use as a performance measure because you can't do much with this source of capital. It's required to run your company. So that's why you look at long-term liabilities and equity only, and you exclude short-term liabilities. These are the sources of capital, which you basically use for the formula here. So why do we have a third figure? First, if you look at NPV, IRR, and ROIC, NPV and IRR are usually better if you look at certain business cases, if you look at projects, if you have more data available to actually do a bit of scenario planning with your future cash flows. Whereas return on invested capital gives you an aggregate view of the company. So unlike project NPV and IRR, you can use ROIC using data available to independent investment analysis because these are usually accounting figures. It's really important that I call it ROIC. ROIC is an aggregate measure to actually gauge a firm's ability to create value. So what does it mean to create value? If your return on invested capital is 10% and your weighted average cost of capital is 8%, is 10% and WACC is 8%, then firm creates value. Why? If the firm goes to your capital providers and asks for $100, to get $100 in the first place, a company has to pay $8. That's your WACC, sometimes called. You can also call it as hurdle rate for your investors. It's basically what the investors, the capital providers, require to give you the money. Yeah, the higher your WACC, the more risky the business and the more return your capital providers require. If your capital providers require 8% for their investment, both as an average, weighted average, debt and equity, means yes, you can use the $100 for your business and you can start generating. Yeah, you can start generating products, you can create services, you can hopefully make some revenue and profit. If your return on invested capital is 10%, means for every $100 that you use from your capital providers, you make $10 return, which you can either use for your own purposes or which you can redistribute, which you can see is a good deal because you get 8 from your capital providers, or you get 100 from your capital providers. You need to pay $8 to get 100. You use 100 to create 10. So the firm creates value. If it's the other way around, if your return on invested capital is 5% and your WACC is 8%, means again, you are asking for $100 from your capital providers. You need to pay $8, otherwise you wouldn't get the money. Then you have 100 available for your operations. You're making 5 money, so you need to pay your capital providers $8 back. You're using 5, but you are $3 short. Means you're losing value. Yeah, so that's why ROIC can be compared to investors' required rate of return. If a company's ROIC is greater than the investor's required rate of return over time, the company is creating value for the investor. Otherwise, it's not. Really important, ROIC, unlike NPV and IRRs in accounting, not cash-based, because here we're looking at accounting figures. We're not looking at free cash flow. So it's really important that operating profit, or what it means is that operating profit and cash flows can differ materially owing to the recognition of certain items and the difference between depreciation and capital expenditure. So just keep an eye out when you compare measures like NPV, IRR, which are cash-based, with measures like return on invested capital. A return on invested capital, because it's an accounting figure, is backward-looking. It's not forward-looking. NPV and IRR is forward-looking because we are doing a scenario, and usually we do a forecast how the world could look like. IRR in particular, IRR and ROIC are measured in percentage. NPV is a dollar figure. Yeah, again, but we would do the same. We would compare ROIC with WACC, or sometimes in private equity, they compare internal rate of return with WACC because it's a scenario, it's a project for them. So IRR is forward-looking and used for individual projects. ROIC is backward-looking and used at the company level. Yeah, it tells us how efficiently the company has used capital historically to generate returns. Yeah. So as a conclusion, ROIC is good for evaluating a company's overall capital efficiency. For evaluating projects, IRR is better. And comparing ROIC to required rate of return, for example, WACC, helps to assess whether the company is creating long-term value. Yeah. So another method, you're well equipped if you use return on invested capital, IRR, and NPV. Again, different scenarios, different ways. ROIC usually a bit easier to use because you're using accounting data, no paid invested capital. You can use benchmarking companies, and it's less sensitive to assumptions when we talk about exit multiples or projections into the future. Yeah. Again, lastly, why is IRR used so many times in PE, venture capital, and M&A? Because IRR is a kind of deal level return metric, because it's a deal, it's a project. That's why it's quite common to use IRR. But if you look from a CFO perspective to think about, okay, how well are we doing as a company, return on invested capital is the appropriate measure. Thank you so much for listening. I hope you found this useful. See you in another video. Bye-bye.